How are you? Happy Thursday. Real quick video. I've been thinking, over the years I have met with many clients and they put $1, $2, or $3 or $400 extra in their mortgage payment every month. You think that's good? In some cases it is. Sometimes they make 2 or 3 extra payments a year. Is that good? In some cases. I'm here to talk about in the cases that it's not good. In many cases it is good. You know when it isn't good? It's not good to make extra payments on your mortgage when you have high interest credit cards. If you have high interest credit cards at 14 or 16%, you should not be trying to save money on your mortgage when it's at 3.75. That just doesn't make any sense. If you have a car payment at 7%, you should be trying to pay that down, not trying to pay off your mortgage at 3.75. If you have student loans, maybe those would be the last ones you would get to, but you would try to pay those off because normally they're in a higher interest rate. Remember, mortgage debt is tax-deductible debt. Tax-deductible debt. That means, in many cases, in most cases, if your interest rate is 3.75, after you take in consideration the tax benefit, you're really at 2.75. That's outstanding. That's cheap money. Some people put extra payments in their mortgage payment. They have a 401k and they don't even max it out. You know, companies match you dollar per dollar. You make 100% on your money instantly, or 75% on your money, or 50% on your money. You make $200 into $300 in an instant. You're not going to do that by saving on your mortgage. Or if you're a government employee, you may have a TSP. If you don't have access to either one of those, you can get what's called a Roth IRA. A Roth IRA is a great way to shelter money for the future and for retirement. You should not be putting extra money in your mortgage if you do not have an IRA, a Roth IRA that's maxed out. Why? Because it's going to give you the most bang for your buck. And you should definitely not be putting any money into your mortgage if you don't have life insurance. You're trying to protect your family. Why are you making extra payments? If you have a family and you're the sole breadwinner, or you guys are barely making ends meet, life insurance should be priority number one. Trust me, I talk that from personal experience, and I will be making a video on that on one segment because I believe in it so strongly. Now, very simple. I don't sell insurance. I don't do 401ks. I don't do investments. That's not what I'm here. I'm not trying to teach you about certain investments because I know what I do, but that's not my job. My job is just to do loans, for mortgage people. So I'm going to stay to what I know, but I am still going to share what I think. I think I have that prerogative. Again, this is just my thoughts. There makes no sense to pay 14 or 15% interest rate on your high interest credit card trying to save 2.75 on a mortgage. You say, well, that's 30 years worth of debt. Interest is interest. You pay interest on a daily basis. That's how it's calculated. Whether it's a 30-year mortgage or a high interest credit card, you pay interest on a daily basis. 17% APR over a year, you divide it over 365 days, that's your interest. 2.75 over a period every year, APR, you divide it by 365 days. Interest is interest, sir. So you should definitely not put money towards your mortgage until you've maxed out your 401k, your Roth IRA, and you have no debt. That's the best thing I can tell you. It's cheap money, 2.75, 3.75. There's no rush.